Hi everyone, it's me, your Manu Ishu, and welcome back to my YouTube channel Manu Ishu ACCA classes. So in this video, I will be dealing the first question of the Kaplan kit, and this one is from the advanced taxation. So I guess this is my first video from the exam kit, and so stay tuned to my channel for the further more video in the coming days. So I just request everyone to subscribe my channel and share it among your friends. Okay, so in this question, first we will read out the scenario and then we will go ahead for how we should draft the answer. I have just draft roughly for your just view how to get from the scenario what the things will be applicable, how the relief will be identified, right? So the question is Gale and Bate, and we should assume that today is 1st June 2024. Your manager has had a meeting with a girl and her father, Brad, both of whom are the client of your firm. Gail owns the whole of the ordinary share capital of Aero Ltd, and advice is required in respect of corporation tax issue in relation to disposal of building and some shares, extraction of funds from the company as either bonus or a dividend, consequences of non-disclosure of the income, and inheritance tax consequences of the lifetime gift. So these are the topics which will be applicable in the exhibit. So we have to identify from these are the topics which will be relief applicable, how the gain and tax is calculated. Okay, we will go through the scenario and get out the things, right? So first, in first exhibit, it has been told the background about the Gale, and Gale was born in this particular year and is resident and domicile in the UK, and she owns the whole of the ordinary share capital of Aero Ltd and works full time as a director of the company. So first of all, the first thing you should the things that came in your mind, that yes, the person is a resident and domicile in the UK, so no issue of non-domicile and overseas one, right? And second thing, as she on the ordinary share capital and also a full-time director, so for then your mind must reflect BADR relief, business asset disposal relief, right? So we will move off reading the scenario further and see whether it's applicable or not. But it's, our mind should give a hint while reading the scenario. Yeah, this thing will be applicable here, right? Okay, so A Ltd on the whole of the ordinary share capital of Jaifer Ltd means Gale owns the share of Aero Ltd. Just let me make a diagram. So here is a Gale, yeah, and Gale on the share of what is that? A Ltd, right? And Gale on the 100% of the share. Gale on 100% of the shares, and A Ltd on Z Ltd. Okay, and the A owns the whole ordinary share, and that's also 100%. So the things that your mind should give hint here is 75% group and 75% capital gain group, because Gale own directly more than 75% of ALTD, and ALTD own directly more than 75%, and Gale own indirectly more than 75%, right? So if we talk about the both 75% group and 75% capital group, there are condition in case of 75 group, there should be ownership of 75% directly as well as indirectly. Both conditions need to be satisfied, and here he satisfies. So it seems to be A Limited and Z Ltd forms a capital gain group. Sorry, capital 75% group. And other, in case of 75% capital gain group, there is condition that the directly ownership should be more than 75% and indirectly 50%, and the both of condition is satisfied here. So it seems both of them form a 75% capital gain group as well as 75% group as. So this hint should be given by your mind by reading this scenario. Okay, so and gain will not be from the part, because when individual control the two company, individual will not part of the group, right? This will be part of the group when in the VAT situation, when there is VAT group, individual can be also the part of the group, but in case of the company, individual cannot be a part of the group even though they own more than 100%. Okay, Okay, so both company are UK resident. Again, no issue of CFC, no issue of your that other part. What is that? Oh, I forget the name. Whatever, there is no issue of non-resident company. Okay, so A Limited and Jet Ltd pays both corporation tax at the main rate. Fine, and historical transaction of the A and Z Limited has been given. So on the 1st January 2016, A Ltd acquired ordinary share capital of Z Ltd. Okay, so this was the date it was acquired. And on October 20, A Limited sold a building named Simpson Building to Z Ltd for 110,000, and A Ltd has purchased this building for 75,000 on 1st December 2012. See, I'm not going to what the scenario is requirement has asked, but I have to identify the maximum possible thing from the scenario. So after reading this line, my mind gives the hints about the no gain and no loss. And when this will be applicable, when a two company are the part of the 75% capital gain group. Just a second, my phone is ringing. So okay, and where was I? Okay, yeah. So now my mind give the hints about no gain, no loss because both of them are the part of the group. So any asset transfer between them, whether it's tangible or intangible, they will be at no gain and no loss. Okay, but the asset transfer is at the cost plus indexation allowance, but transfer will be not be subject to CGT. So my mind give hint about this. And on 1st March 2012, A Ltd sold the brand to JLDT for 170,000. Its market value at the time was 2,000, and A Limited had purchased this brand at 150,000 on the June 2018. Yeah, this will be also applicable letter for no gain and no loss transaction, no subject to CGT. But this asset will be transferred at the book value of the A Limited, so that tax neutral position will be applicable. I hope you guys remember the rules of intangible asset in case of the company. And other thing you have to remember here, the brand will not transfer the cost plus indexation allowance. Indexation allowance is not applicable in case of the intangible asset. They are transferred at the book value, so that both the person receiving the asset will be at tax neutral position. Okay. So while reading the scenario, your mind should give the hints like this. Just I'm showing. Okay. Okay, so proposed transaction, all transaction will take place at market values, no issue. GAIL intend to raise substantial sum of money by carrying out following transaction. Okay, so GAIL want to raise some of the money. Okay, so 24 June 2024, JED Ltd will sell the Simpson building on unrelated purchases for the 140,000. Rollover relief will not be claimed in respect of this disposal. See, this Simpson building was transferred by A Limited to JED Ltd, right? So this was the part of the capital gain group, 75% group. These two companies are the part of 75% capital gain group. So any asset transfer between them are no gain and no loss. So if the Simpson building sold by J Limited prior to leaving the group, it will be not subject to de-grouping charge, because in order to rise the de-grouping charge, the asset must be owned by J Ltd before leaving the group. But Z Ltd sold this asset before, so no regrouping charge will be applicable here. So Z Ltd will pay dividend at A Ltd equal to post-tax proceed of this sale. Okay, fine. So Z Ltd will pay dividend to A Ltd, and in case of company, there will be no tax on the dividend, right? Okay. So be careful with this term as well, because we have to deduct tax from the proceed, not from the it's chargeable gain or the whatever taxable amount remaining. Okay, so we will do the calculation. We will get on this point as well. Okay, so 1st July 2024, A Ltd will sell the whole of ordinary share capital Z Ltd for the 250,000. Yeah, what happened? A Ltd has now sold of Z Ltd. So now it means Z Ltd has left the group, and Z Ltd is no more part of the A Ltd group. So now what will happen? So the Z Ltd already sold this Simpson building earlier, right? So this building has been sold, no de-grouping charge will arise. But in case of the brand, still the JED Ltd on this brand at the time of the leaving the group, so it will be subject to de-grouping charge, right? So this point, your mind should give hints like this, right? And other thing, as the share has been sold, if one company is selling the share of other company, in that case, remember the substantial shareholding rules, where the individual own at least 10% for 12 months. In last 6 years, they will be exempt. So in this case, A Limited has purchased these shares of Z Ltd on the 1st March 2022. Sorry, no, it was not the case. On the 1st January 2016, right? And sold this share on 1st July 2024. So it is more than 6 years, I guess, right? So in that, and this ALTD own whole share, and if it is more than 10%, it means this whole transaction will be exempt. It means no gain, no loss, and whatever the degrouping charge was arising due to the brand, it will also be exempt, right? Okay, so moving ahead. 15 July, all the cash received by ALTD as a result of transition 1 2 will be paid to the GIL in the form of either dividend or the bonus. Okay, so now the cash will be paid to the GIL who is individual in the form of dividend or the bonus. So now listen the consequences very carefully. In case of dividend, if the company is giving the dividend to the shareholder, it will be not be allowed expense. An individual who is receiving those income in the form of dividend, they have to pay tax according to the dividend rate slab. Okay, and it will be not the form of the part of the UK relevant earning, because it's not a part of employment. And in this dividend, individual neither employer have to pay any NIC, right? This will be the case. But in case of the bonus, it will be added to the individual employment income, and on those employment income, individual and the owner have to pay NIC, and individual have to pay tax, and this will be the part of the UK relevant earning while making contribution of pension. So these are the benefits and consequences if it will give dividend and bonus. Just I have given a brief of the consequences will arise. Okay. Okay, so non-disclosure of the income. Gill has realized that she has not declared some of her income in respect of a tax year 2019 and 20. As a result of this, her income tax liability for tax year was understated. Okay, so I have already explained the interest and penalty which has been charged in respect of this error. Okay, fine. So basically, they already told, they have explained the Gail that whatever the penalty and interest will be charged. So the things should my what the point should came in your mind is that if the Gail has disclosed this error to the HMRC, fine, no issue, but not in that case consequences arise like money laundering, criminal proceeding. Whether our firms should also decide whether to cease to act for the GIL or not, or inform HMRC. So these will be the consequences if not disclose this error to HMRC by GIL. Okay, if it has disclosed, then no issue. Okay, so these are the schedule prepared by the mail regarding the amount of cash proceeds received by the GIL. So this is the all calculation given. Okay, fine. And they talk about the like SSC available or not, the grouping chart available or not. We will look into this later on. And third exhibit, let it be on the hold for now. Okay, so what where is the work to be carried out? Yeah, this is the part. Okay, so in first requirement asked by is to prepare a note. I must say you guys must know the note format. We will write to tax file from tax senior date subject, right? So these will be things will be included in while making the format of the notes, right? Okay, so I can confirm that there are no computational errors. Our manager is telling us, and in the schedule, but I suspect that Mealy will have made a few technical errors. Fine, please identify and explain any error in the schedule. Explain whether or not notes to schedule are or not correct, and calculate the correct amount of total cash available to pay the bill. So you have three things you have to be done. You have to identify, then explain the error, and explain whether or not anything she has included is correct or not. And other thing, you have to recalculate the amount. You have to calculate the total amount paid to the GIL. And we have given an indexation allowance. Fine. Okay, let's do this first part. So where is the schedule calculated by the MIDI? Yeah, this one is the schedule calculated by the MIDI. Okay, so basically the sale of Simpson building by Jaifa Limited at Z Ltd. Where it was the case? Yeah, here it is. The Z Ltd will sell the Simpson building to unrelated party for 140,000, and Millie had kept the 140,000. Fine, this correct. Okay, so cost indexation allowance 20 to 24, and this is incorrect. An amount taken by Millie is also incorrect. As I told, so Z Ltd was part of the capital gain group at the time to sell the building, and this building has been received by Z Ltd from the A Ltd, and both are the part of the capital gain group. So there, this transaction had occurred at no gain and no loss, right? So, the asset has been transferred at cost plus indexation allowance, right? Asset has been transferred as cost plus indexation allowance. So now will be the cost incurred by A Limited while purchasing this building, and here it was given somewhere. Yeah, it's 75,000 when A Limited purchased this building on 1st December 2012, and indexation allowance will be from 2012 to 2017, because after December 2017 it has been freeze, and the question has already given us indexation allowance. Here we can see. So we will took 75,000 into plus, sorry, first we will calculate indexation allowance 75,000 into 0.127, and then add this to 75,000. I have done this for you, just wait. Yeah, here is the format. Cost will be 75,000 plus 75,000 into 1.27, right? It will give you the cost of 84,525. All right. So this one is the incorrect mistake done by the Mealy, and then this is calculate the chargeable gain. Okay, so this okay, and corporation tax payable fine. Yes, sir, this is the part. This gain will be the part of the company, and company have to pay corporation tax. And the question has told the both company pay tax at the main rate, so 25% is correct. Dividend of the post tax received to Aero Ltd. Okay, so this will be the paid as dividend to Aero Ltd. We have to recalculate all these figures in order to arrive at the correct one. And corporation tax payable on the Aero Ltd at 25%. See, we don't have to pay any tax on the dividend. It is exempt in case of the company. So this one is incorrect, done by the Millie. So we have to omit this. This is not correct. And after that, the cash will be sale of index bill. Definitely, yeah, fine. So these two are the error done by the Millie in respect of this building. So I have done this here. You can see. Okay, cost of sensor building taken by the Millie in the market value, which is incorrect, and as Jaipur Limited and A Ltd has been the part of 75% gain group, because both of them controlled by the, controlled directly. It will not be the, this should not be the buy. Okay. Control directly more than 75% and indirectly more than 50%, and being a part of 75% group, the building will to transfer of building to Z Ltd subject to no gain and no loss, and therefore assets are transferred at costless indexation allowance, and here the cost is 75,000 and plus indexation allowance I had calculated, and therefore I added the cost of the simpler building including the schedule provide should be 84,525. This is what I discussed till date for the this part of the requirement, and I guess this is no more difficult, easy one, right? So again in second point I mentioned that a dividend included by the Millie is incorrect, and the tax deducted by the, yes sir. One more point you can notice that the Millie has deducted the tax from the, Millie has deducted this tax from the this chargeable gain, which is incorrect. Sorry, this dividend profit, which is incorrect. It should be deducted from the 140,000, right? So I had explained about this in the answer. And regarding the notes, Millie saying she don't think there will be chargeable gain on the sale of Jaffa Limited due to the substantial shareholder exemption. Exactly what I explained. Here I have explained that share of Z Ltd sold by A Ltd on 1st July 2024. Therefore, Z Ltd is no longer part of the group, but the added share was held by A Ltd for 12 months in last 6 years, and having a holding percentage of more than 10%. Therefore, the gain arising on this sale is exempt from exempt. That means no subject to CGT, and Lily was correct in this regarding. I had explained about this, and she was thinking there will be regrouping charge in respect of the brand and how to compute it, she don't know. But she was correct, there was regrouping charge, but being the part of the capital gain group, it was exempt. It will, I mean, sorry, being the qualify for the SC relief, it will be no more chargeable now. And I had explained about these things here in the fifth point. Okay, and I recalculate the figure. Okay, so I forget to add these two. We need to add these two, right? Okay, fine. So we done with this part. Mm-mm. Okay, so what was the next requirement? Okay, calculate the additional tax and national contribution due as reduced by the any corporation tax saving if all of the cash realized by ALPD as a result of the proposed transaction. I already mentioned about how to get this done while explaining scenario, and I think this is no more difficult part. Okay, so regarding non-disclosure, they're asking state the other matter which need to be considered by us by GIL in relation to the disclosure of the error of to HMRC. So basically, other matter is that we should first of all, we will ask the client to disclose this error to HMRC, and if the client has given us authority to do so, in that case, we will inform the HMRC, no issue, but we won't inform until and unless we have permission to do that. And if the client denies the fact to disclose the HMRC, in that case, what we will do, we will cease to act for the client and inform HMRC that we are no longer agent of the particular client, and reason for required no necessary to be mentioned. So these are the things we have to explain for that point. Okay, so let's discuss about the exhibit 3, and I think this one is for the exhibit 3. Okay, so Gail father Brett is 70 years old and is married to Laura, and he was always UK domicile. So again, husband and wife both are the, sorry, husband has the UK domicile, and Brady estate is worth approx 5 million. He has not made any lifetime gift, so it means full NRV is available, right? And in his will, he intends to leave half of his estate to the daughter. Ensure that in this estate, whether there is main residence or not, if main residents are involved, in that case, he will, Brett will be entitled for 175,000 additional nil red band, so called as residence nil red band, and half other half to the wife Laura. It means it will be exempt. And I pointed out that that it may be an advantage to make a lifetime gift to Gail. Okay, and Brad agreed to consider giving Gail 1,500 of his share in omnium liability and had asked for general summary of inheritance tax advantage of making lifetime gift to individual. See, in case of any gift made during the lifetime, there are lots of benefits. For example, if first of all those gifts are considered to be the potential exempt transfer because as the gift is given to the individual, and other point, if they do not survive for 7 years, it will be exempt. Even the die for the 7 year, die within 7 years, but survive at least 3 years, taper relief will be available, right? And there are lots of exemption like small gift exemption, marriage allowance, normal expenditure out of the income. Lots of their relief are available in that case, which will be reduce the value of gift, right? And other point to be considered here is that if the value of asset is increasing one, so whatever the value at the time of the date is, it is ignored because the value of the gift is locked at the time of the gift, and which will be considered for the calculation of IST. Any increase in the value of asset will be ignored. Other advantage is that if there is fall in the value, in that case fall in value relief will be available. So these are the general advantage of the inheritance tax which Brad wants to know. And Omnium Ltd is unquoted company share. So after reading this point, my mind just hit for the BPR relief, business property relief, because it's unquoted company share. So now we have to confirm whether company is like trading one or investment one. Okay, and whether the ownership has been satisfied or not. If these two case has been satisfied, that's 100% BPR relief will be available, right? And but the scene not ends here. If the BPR relief is available, in that case, the furthermore condition need to be keep in the mind, like donors should keep those assets at least till the date of the donor. If the donor sold out this asset before the donor date, in that case, what happens? BPR will be withdrawn and subject to IST. And in the even though the asset has been disposed of, and any positive receipts should be invested immediately in other qualifying asset, otherwise BPR will be withdrawn, right? So these are the points that should be keep in the mind while giving the while you are eligible for the BPR relief. Okay, and so they have given the value percentage of share. Yeah, now if the question gives you figure like this, your mind should hit for the that in case of shareholding, related party holding percentage also need to be considered for the valuing of the shares, because here somewhere written that the Braid wife also on the other part of the shares and some part of owned by the Braid, so both party holding need to be considered while valuation of the share. Okay, okay, fine. So these are all the things about the scenario. Okay. So what the question is asking with us, explain the inheritance tax advantage of making lifetime gift to individual. I had already explained about this a few minutes ago. You can just recap the video, watch it again. And in respect of the possible gift of 1500 share in Omni Ltd to Gale, calculate the fall in the value of bid state which will result from this gift. In this part, they're asking about to apply diminution of value concept, where the we have to consider the value of asset before the gift and after the gift. So I have already done this for you. You can have here check just a bit. Yes. Okay. So before the gift, Brad is having how many shares? 3,000 share, and his wife is having 45 share, right? So altogether they are having 7,500 share, and for 7,500 it means they are having 75% of the company, and value of 75% share is 290. So just multiply 3,000 into 290, it's give value of 870,000. So after the Braid give 1,500 share to her daughter Gail, in that case the remaining share is 1,500, and her his wife still is having 4,500. All together 6,000 share they are having. So it's 60%, right? And this 60% have the value of 240,000, so which gives the value 360,000, right? So difference is 510,000. So this is the transfer of value that the question is asking for the fallen value, right? Calculation of fallen value. So next part is provide a detailed explanation of whether or not BPR relief will be available in respect of the gift, and the assumption that it would be available in the manner in which it would be calculated, and state briefly and other tax issue arising from the gift which we will need to be considered at later date. See, I told earlier as well while reading the scenario, again I'm repeating. So BPR relief, you have to consider two things: whether the transaction is qualifying or not, and whether the ownership period of 2 years is satisfied or not. Even the ownership period is satisfied and transaction is satisfied, we have to look whether this company is trading or investment one. If trading, fine, you will get the BPR relief. If non, if it's like investment property, investment category one, in that case, no BPR will be available. Suppose you satisfied for the BPR relief, even though in that case, what you have to do is you have to hold this share till the date of the donor. If you have sold out before the donor, and you must invest those share those amounts into other qualifying transaction in order to get BPR maintain relief maintained, right? Otherwise BPR will be withdrawn and you have to pay IST. Okay, for this part you have to discuss all these points. And for last part, they're asking about any issues arise from the gift. Yeah, if you're gifting the shares, in that case you have capital gain tax will be arise, and there are other relief as well in capital gain as tax, like gift holdover relief. So in that case the gain will be deferred. And other issue will be regarding tax point of view is STLT, but this will not be applicable in the case of gift of the share. So these are the points you have to discuss, and I had already discussed in this PDF. If you want this PDF, I can share with you. So my main motive is to make you clear how the things will run in the scenario and how your mind should click for the particular relief and explanation of the things, right? So my motive is this behind this making the video. So I will make other video as well, and we will do following the same approach. So stay tuned with me for that. You have to subscribe my channel. So thank you so much for watching my video.